What is hotspotting? I'm Mark Wyld. Wyld Money starts now. Data is the heart of getting a property investment decision right, finding the right property, the right place, the right time. So today we interview Tim Graham, the Director of Hotspotting, one of the largest publications of property investment data in Australia.
Tim, Mark.
Welcome to the journey.
Thank you. Pleasure to be here.
So starting off, Tim, now I believe hotspotting plays a very critical role in the Australian property investing landscape. Just as with a media company to a politician, I see hotspotting as that important. Is that how you see it?
Well, we'd love to think we've got that much influence. I don't necessarily think we do, but look, we've obviously been around since 2006, and we're relied upon by not only consumers to find the best locations to invest around Australia, but also more and more we're starting to see a lot more real estate professionals relying on the insights that we provide. So no doubt we're having somewhat of an effect on these regions that we choose, but I can't say that we're necessarily creating any bubbles.
In saying that, with a lot more professionals like coming to hotspotting, what do you feel the divide between professionals subscribing to hotspotting to fuel their business versus novices just getting the casual subscription and using that to try to build their property portfolio?
Yeah, it's a good question. I think it really comes down to the individual. Some people decide they want to go about this on their own, and they think, look, I don't need the services of a buyer's agent or a financial planner. But then there's other people that are time poor, and they really rely on those buyer's agents and professionals to help them to navigate their journey.
So, given that your subscription, a lot of buyer's advocates use hotspotting. I mean, I was on social media, I think last night, scrolling through, and I think I saw 2 or 3 ads from buyer's agents, and I know from what they're saying in those ads, they are definitely leapfrogging off the hotspotting subscription. So given that these professionals have subscriptions and they're using that subscription to advise other clients, what do you feel the best advice that a buyer's advocate can give someone trying to enter into the property market and build a big property investment portfolio?
Well, firstly, I'm glad that they're using it because at the end of the day, we really want consumers to have, either through their own research or through an agent, we want to make sure that they're getting the right research at the time. So I'd be hoping that the people that are advising them have got the right research to actually back up the decision making on buying in those locations. Okay.
So what other elements come into it from using a buyer's advocate? Would it be more, finding the specific security? I mean, obviously you do all the hard work with the location, why that location might boom, what to look out for, climate risk, all that sort of stuff. But when it comes to actually finding the single dwelling, do you feel as though, I guess, that's where the buyer's agent services come to fruition?
Yeah, well, I mean, traditionally, in real estate terms, the vendor has always been accommodated by a professional in a vendor's agent, but the purchaser hasn't, and it's only been in recent years that we've started to see a lot more people using the service of a buyer's agent. If you think about it, whether you're the vendor or the buyer, it's a very expensive exercise if you get it wrong. So as a purchaser, I think it's a wise move to enlist the advice of a professional who can not only help you identify the location, but also negotiate on your behalf and select the right investment. Because we always say at Hotspotting, the location you're going to buy in is going to do 80% of the heavy lifting.
Is that right?
Yeah, but the property that you buy will do the balance. So it's important that you get the product mix right, but the location that you're buying, I believe, is going to do a lot of the heavy lifting for you.
Okay. So with investing into property, I mean, I've been a financial planner a lot longer than I've been a buyer's advocate, but with investing into property, so up until a couple of years ago, I always had the view that, okay, well, if you want to invest into property, then why not just buy a 3 or 4 bedroom Victoria cottage within 5 kilometres of a major metropolis on the eastern seaboard of Australia that everyone loves, right? It's always going to be in demand. Perhaps it has some character features, close to all the amenity you want. So if you bought that asset, I feel as though I probably don't need a hotspotting subscription to tell me that I'm probably going to lead the pack with capital growth over a 20-year period. Do you subscribe to that view as well?
That's a really interesting point, and I think the first thing I would say is that not everybody can afford to buy into those locations.
Right.
So I think first and foremost, where our hotspotting research really comes in is to help people in that affordability bracket. 400,000, 700,000 bracket is where we find that, one, people can get the finance for that type of investment. It's also where we can get the best rental yields. The higher we go up in price, the quicker the rental yields drop away. And the second thing is, if we look at the post-COVID world, the 4 years that we've sort of seen post-COVID, the regions have really outperformed the capital cities as well. Like it's only in recent times we're starting to see the capital cities really come back into their own, but 9 out of the 10 best performing locations in 2023 alone were all regions. Yeah,
which is obviously a short-term play. So would you feel your members are mainly people looking for affordability with their property investing journey?
Yeah, I would say that a large portion of them are. We're getting a lot more in recent times, starting to look at that $1 million plus. But I would say that 80% of our customers are really looking for that affordability investment. If you think about it, as a mum and dad investor, they've probably got a bit of mortgage on their own home, and the priority is always to pay that down. So where we're focusing on the investments between the 400 to 700 bracket, with a good rental yield, it should be paying its own way, and any extra cash flow that we get can be helping pay down the owner-occupier debt.
So, good point. So is it a myth that we can't have our cake and eat it too, in the sense that we can have good yields and good capital growth? Because most people think they're isolated, you can't have both together. So I guess you're here to potentially dispel that myth. So what's your answer to that question?
Look, I think it is a myth. It's been a long-standing myth that you can't have strong capital growth and a good rental yield. It's either one or the other. And we produce a report called The Pulse, which is specific for the top 50 locations in Australia that we put through what we call the empirical formula, which is identifying locations where we can get, at the moment, it's a 5.1 to 8.1% yield, and we're still seeing capital growth in the last quarter alone. If you got that capital growth that we saw in the last quarter in the top 50, you'd be happy with that over an annual period.
So take me through the numbers, be specific.
Yeah, well, look, if we look at the last quarter that we've just analysed our results, in the last quarter alone, we've seen some double-digit growth in those locations. We annualise that, you're looking 20% plus. And we're still getting yields that are positive cash flow. So you definitely can have your cake and eat it too.
So with the 5 to 8% yields you're referring to, because I think just asking questions about this is what's on everyone's lips, because in an ideal world, if I can hold an asset that is not costing me much money or even paying me a little bit of money, then why wouldn't I do that? Like, let's do that. So this report from the 5 to 8% yield, so are they literally the top performing suburbs or local government areas in Australia, like
well,
50,
certainly in our mind it is, So as I mentioned, if you think about it, if you've got debt on these properties, after the amount of interest rate rises that we've had over the last 2 years, cash flow is very important. We can't be paying a mortgage at home and also be forking out money for our investments as well. So positive cash flow is great, because we can funnel that money back into the owner occupier, or if we're looking purely on a capital growth play and we just don't want to be tipping too much into the investments, some of these locations are giving, as I mentioned, double-digit growth, which will allow you in a couple of years' time to potentially sell down and wipe off a large chunk of owner-occupier debt on your own home.
So I mean, your cash flow plan is so important, right? So non-deductible debt, I mean, I guess that can kill you from going into other investment properties. We're very big on our financial planning company on helping people really accelerate their non-deductible debt as fast as they possibly can. So really honing on that, and if they can do that, potentially going into more investment properties from that point. But back to the Pulse report. So with the growth rates that you were talking about, so it's all about growth. I mean, obviously the cash flow side of things is great, but I'm not going to get rich off an extra couple of $100 a week. Right. So focusing on the growth, how much conviction do you have that you're going to see at least the national, I mean, obviously you spoke about short-term growth, which is great, but obviously we're here for long-term growth. So how much conviction do you have in the empirical formula to deliver on solid long-term growth, at least equal to the national average Australian growth rate?
Well, firstly, even to discuss the word hotspotting, a lot of people think a hotspot is flash in the pan, quick spurts of growth, and that's quite the opposite. Whilst we do want capital growth in the short term, it might be catchy, but we're looking at long-term growth, and we won't put anything into a top 10 that we don't believe will give us long-term national averages well above the national average. So if we just look at the next 12 months, we're very, very confident that the locations we've chosen will get double-digit growth.
So back to my example before about the Victorian cottage in a 5 kilometres of a major metropolis in Australia, obviously it's obvious why that should keep going up and lead the pack from a national average growth rate. But just take me through, I guess, your empirical formula and why that formula can potentially mimic the same growth characteristics of that example property I just outlined.
Yeah. So one thing on that property, whilst I do believe it'll likely be a good investment, being close to everything, the other thing that you have to think of is if you have debt associated to that, regardless of how much growth you get, if you want to replicate this formula and buy again, you still need borrowing power. So if you bought a property worth 800, 900,000 and had $700,000 worth of debt, it doesn't matter how much capital growth you get if you can't borrow again because you still owe 7.
Yeah, I get that.
So that's why we tend to focus on that 400, 700 bracket where we can keep our debt level low, have strong round 2 yields. The banks are going to favour us when we go back to the bank and say, can I go again?
But it sounds almost too good to be true. But we know it's a perfectly legitimate trick. So to buy a property that's going to pay you money or slightly negative, but mimic the growth characteristics of that property that would murder you from a cash flow perspective. Just for the people listening, just take me through the empirical formula and what you look for, what statistics you look for to get the yield plus the growth.
Yeah, it's a good question. So typically, if you think about the Australian market that we hear about in the media, there are thousands of property markets within Australia, and we believe they're very much driven by local economy. Okay. So the first one that we're looking for is a really strong and diverse economy. The next thing is a minimum market size. So we're not looking at small little rural towns that'll never see any growth, and if they do, it could be that quick spurt and then there's nothing afterwards. Population growth. So we want to see strong population growth come into the area.
I mean, we're not going to get through the entire formula in time, but population growth. So what mainly drives population growth? It sounds great, but what drives it?
Yeah, I mean, it could be international migration. Sometimes, and it's what we've seen in Queensland, has been immigration from internal migration coming into the Sunshine State. So we're seeing a lot of markets like that that are actually very buoyant because of people moving from interstate. Adelaide's been another example of that.
They just can't afford to live in the Melbourne and Sydney.
Could be lifestyle, different medium price point. If you think about the amount of jobs that are getting created in Queensland at the moment as well. Sunshine Coast has been an incredible story from that. Okay.
So I mean, infrastructure, would you say all of the government spending on an area is good and creates population surges, is going to cause sustainable long-term trends?
Well, infrastructure is a huge part of it. We've often talked about infrastructure booms, and typically if we follow that infrastructure boom, we can see
chat to you about infrastructure another time. But Tim, thank you so much for joining me. That's the program for now. Thank you for joining me. I'm Mark Wyld, Wyld Money. See you next time on Ticker.
You're watching Ticker. We'll have more in just a few minutes.